If you go back to 2020, when the world lost their minds and passed the dumbest set of rules in the history, literally, of mankind, and that's hyperbole, but I believe every word of it. You know, we took the seasonal flu, we weaponized it, and we ran a control experiment on the world to see how much shit people would actually take, right? And because of that, they convinced, there's this group in DC called the Cult of Kelton. Stephanie Kelton convinced the politicians that they could issue as much debt and as much money as they wanted with no consequences because we have the world reserve currency. That's one of the dumbest ideas in the history of economics. And economics is replete with dumb ideas. I mean, there were lots of dumb ideas. That's the dumbest of all of them.
Today's video shows a snippet of an interview from the Crypto Nutshell YouTube channel, which features Mark Yusko, the founder of Morgan Creek Capital and manager of hedge funds. If you'd like to watch the entire interview jam-packed with price forecasts in which Mark shares his thoughts on the ideal way to exit the cryptocurrency market by 2024, it's the first link in the description. But without further ado, let's get back to Mark Yusko.
My point is, yes, liquidity drives markets. Forever and always, liquidity drives markets. But the point that's missing there is it's not that Bitcoin is a risk asset like, you know, tech stocks or venture capital, and that's being driven by liquidity. I think it's the exact opposite. It's the creation of money, okay, which is the unit in which we denominate Bitcoin, is what drives the price. So if the money supply stayed the same, the dollars per Bitcoin would stay the same. And the only thing that would move the price of Bitcoin would be the demand for Bitcoins, the actual tokens, relative to their supply. But that would be, you know, ceteris paribus, all things equal. But all things are not equal. Sometimes the money supply is expanding, sometimes it's shrinking. And yes, Raul's right, there is this liquidity cycle and debt repayments and all that good stuff. But here's the thing. The money supply over the last 12 months has contracted, actually for the first time in 100 years in the United States. And yet, the price of Bitcoin almost doubled. Well, how can that be? Well, it's because the uncoupling of those cycles, in the sense that if you go back to 2020, when the world lost their minds and passed the dumbest set of rules in the history, literally, of mankind, and that's hyperbole, but I believe every word of it. You know, we took the seasonal flu, we weaponized it, and we ran a control experiment on the world to see how much shit people would actually take, right? And because of that, they convinced, there's this group in DC called the Cult of Kelton. Stephanie Kelton convinced the politicians that they could issue as much debt and as much money as they wanted with no consequences because we have the world reserve currency. That's one of the dumbest ideas in the history of economics. And economics is replete with dumb ideas. I mean, there were lots of dumb ideas. That's the dumbest of all of them. And so we've been a republic for 247 years and 248 years. And for the first 244, we issued $10 trillion. Then we issued $10 trillion in 2 years. That was a bad plan. And so if you think about it, if we doubled the money supply, what should have happened to the price of gold and Bitcoin? They should have doubled. Curiously, if you go back right before the pandemic, Bitcoin is around 15,000. And before the shenanigans with Sam, it was at 30,000. That's really interesting. And that's just Bitcoin denominated in dollars. And the same thing happened at my house here in Chapel Hill. According to Zillow, my house went up by 50%. No, it didn't. My house did not grow. My house did not get more efficient. I actually had to put money into it because we were wearing out, but that's not the point. What happened is the money got worse. The money went down. The money was devalued. And so what happened was Bitcoin got pushed below its fair value, its fair exchange value of 30,000 down all the way to 15,000. Why? Because people were afraid of the liquidation of FTX and all the scandal and was Tether a fraud and all this FUD. And so you had a temporary dislocation. And so, yes, money supply was contracting, and yet Bitcoin prices went all the way back to 30,000 and then higher to 40,000. Not because they are inextricably linked to the money supply at the moment, and not because it's inextricably linked to the what's happening in the government. I believe it's because of the 4-year cycle. And the 4-year cycle is tech, like code, right? It's hard-coded into Bitcoin that every 4 years you decrease the supply by half. That's a really interesting idea. Why would you do that? Well, it's interesting. My theory, and this is my theory, is you do that because it's guaranteeing movement. And if you have a nascent asset, what you need is something to attract attention. And movement in price would attract attention. So if you think about the 4-year cycle, when the price is below fair value, in the middle of crypto winter, right, where everyone is sold, price goes below fair value, investors, right, people like me and others, who our job is to buy things below fair value. That's what an investor does. So they start to buy, and the price stops going down and starts to go up. So then, as the price starts to get close to fair value, the traders come in. The traders don't really care about fair value. They just want to scalp. They need movement. They need things to be stable and moving. They may go long, they may go short. They don't really care. As the price starts to get back above fair value, so you go from crypto winter to crypto spring, then into crypto summer, and in crypto summer, you start to get more movement slowly back towards fair value. And once you get to fair value and you enter crypto fall, where we are today, the speculators start to come out. And the speculators start to come out because the price starts to move more. Then the halving occurs. Well, the halving makes the price start dropping. As I said, the miners aren't going to sell unless someone offers them a bigger price because they can't cover their costs. So they hold longer until people bid more. And so the price starts to move. And this is not politically correct and sexist and all that good stuff, but it's real. Like men, okay, we have the hunter gene from cavemen days or cave women days, and the women are the gatherers, right? And that's the way it was. It's not male thing. It just is what it was. So that person that walked by my office a minute ago, I watched them, right? I follow those movement. I always say, if it ain't moving, I can't see it. And people hate when I tell the story, but it's true. My wife says, get the ketchup. I open the refrigerator door. I say, honey, there's no ketchup. She walks up. She grabs the ketchup. It's right there. If it ain't moving, I can't see it, right? And so once the price moves, then the guys start to come in. And most crypto traders, this isn't a value judgment. It's just a fact, are guys. And they happen to mostly be younger guys. And they tend to be a little more overconfident and a little more over trading, and those speculators come in. But then the problem is the gamblers come in. And these are all walks of life, males, females, older, younger. And these are the people that look at the price moving and they're like, oh, this is easy money. And they borrow money to play it. And that's what gives us the parabolic blow off. And then eventually somebody says, nope, that's too high, and they short it, and we start the cycle all over again. And, we had the futures facilitate that twice, and it'll probably be, something else next year.